And perfect. Here we go. So you guys, welcome to unlocking creative financing solutions for realtors and families. This is meant for not only real estate agents, but especially financial planners. There's a lot of programs out there that people just are not aware of. You cannot imagine how many people come to me and go, oh, hey, I have no income, so therefore I won't qualify, but I have all these assets. Can you please help? Well, of course you can. My goal here is that you're going to be able to have a little bit of a knowledge of a lot of things, to where hopefully something will register and you're like, oh yeah, that's what that Paul guy was saying. Let's get you over to him and let's see if we can qualify you for a loan. I'm going to come at you guys with a lot of information. So hopefully I did it in such a way where it's a little bit digestible. But if you guys have questions, want the slides, anything I can provide you with, feel free to reach out here. So without further, let me bring up the slides here. So some of these slides I'm going to go out and just make them bigger so you can see them. And some of them's going to keep it this way. But the importance of understanding what families' options are can really, not only from a real estate perspective, help you help more families and close more deals, but also for my families out there listening, these are loans that you can use to, help you get a house where everybody's saying no. Financial planners, these are situations, these are strategies that you can use to keep people's assets, growing in whatever you have them. I can't think of the word right now, whatever assets you have them growing in, right? And so what it's done for me is last year in 2024, the market has shifted a little bit. We had to adapt. We started really focusing on alternative loans. And here's the deal, as a result of focusing on alternative loans, and I'm hoping this is what is going to happen with you. Here, let me make this a little bit bigger. Last year, Danielle and myself, I'm very proud of this. Let me go back here. We were, if you can see there, under number 26, we were the 26th top broker in the United States, and we funded over $87 million. And a lot of that has to do with understanding alternative solutions, separating myself from my competition, and making a difference in families' lives. So that's huge, but impacting families is even a better feeling here. So what we're going to talk about here, we're going to talk about a lot. We're going to talk about reverse mortgage purchases, DSCR loans, bank statement loans, and much more, renovation loans, bridge financing, fix and flips. And then we're going to have a little QA session if we're able to on this platform. I do believe, though, if you have questions, you can put it in the little chat box there, and it should show up here, and I'll be able to answer them as they come. So let's go ahead and let's get started with reverse mortgages. So when you think of reverse mortgages, especially if you're in California, do not forget Prop 19. Just as a refresher, Prop 19 allows certain qualified individuals to transfer their property taxes from their existing house to the new purchase. It used to be just a county specific, and you had to buy a house at equal or lesser value. That is not the case anymore. They've opened it up. There's a lot of this is something that is helping a lot of seniors make the move that they want to, not feel stuck in a house that no longer fits their needs. And what I'm hoping here is, number one, we're going to show you the opportunity out there for reverse mortgages, because there's a lot of people out there that qualify for reverse mortgages, don't know it. They're living in 2-story houses, their bedroom's on the second floor, and they really want a 1-story, or perhaps they have a house free and clear, and their only income is Social Security or maybe a little bit of pension, and they're living from month to month. These are things that we can really help impact our senior citizens lead a better quality of life. And by the way, there's like a reverse mortgages 1.0 and a reverse mortgages 2.0. A lot of people still think reverse mortgages are how they were in the past. It's just not the case anymore. A reverse mortgage is an FHA loan, but people aren't required to make a payment. That's the difference. They can, but they're not required to. So over the next, there is a lot of opportunity out here to help a lot of, with reverse mortgages. Just to give you some of the basic differences between conventional and reverse, I'm just going to stick on the right-hand side. There is an age restriction where clearly with conventional financing, there's not. Uh, there's no monthly payments that are required, where if you got a regular house, you would have to make payments. Now, remember, you still have to make taxes and insurance and HOAs, but you do not need to make a principal and interest payment. Their equity decreases as as the loan balance increases. However, just remember, they can still make payments like a forward mortgage and get it paid off. So that wouldn't be the case. So if they choose not to make a payment, then that accrued interest gets added onto the balance. Their liquidity increases. I'm going to show you a couple examples of how, if somebody was to sell a house and buy a house, how they would be able to retain more of their cash on a monthly basis. They can put more money towards things they want to do versus monthly payments. This loan is just absolutely amazing. Borrower owns the home. There's this misconception that they don't own the home anymore. That is just not the case at all. They own the home. Property taxes, insurance, and maintenance must be paid. This is a non-recourse loan. Contributions toward the purchase may include departure home equity proceeds and reverse mortgage proceeds. There's a little rule there that people get caught on. You can't borrow the funds. It's crazy for the down payment on a reverse mortgage purchase. All right, let's go ahead and get into an example. Let's say, for an example, a couple wants to downsize. So you have a 70-year-old couple in Arizona. Their home is worth 500, and they want to buy a new home for 350. Let's say they own their house free and clear. Now they can sell their house and pay cash, but they want to retain as much funds from the sale of their departure home and increase liquidity. So how do we do this? So let's take a look at the left side and work our way down. So if you sold the home for 500,000, man, those realtors in Arizona, they're really getting you at 8%. That's $40,000. This family would receive 460,000. Now, if they bought the house for cash at 350, they would have about $110,000 remaining. Now, let's go to the right, and let's say they take advantage of the reverse mortgage. So if they sold their house for 500,000, 40,000 in realtor fees, net proceeds 460, new home price 350, but now we're using a reverse purchase and we're able to give a loan amount of 135. Therefore, they only need to use $214,000 of the proceeds. So now their funds remaining go from 110 all the way up to 245, 735. And remember, their cash outflows the same. They don't need to make a mortgage payment. And just as if they bought the house for cash, they would still need to pay homeowners insurance and homeowners insurance and property taxes. This can also be used for upsizing as well. So let me go through this example real quick again. I think you're getting the flow of it. Let's go to our left and let's work our way down. Purchase price 500, 40,000 to sell, right? Net proceeds 460. They want to buy a house for 650,000. Funds required would be $190,000. That's that difference between the purchase price and the net proceeds. Well, let's say we use a reverse mortgage. You have sale, right? Let's go all the way down to new home price of 650. From there, we can do a reverse for purchase, do a loan amount of 259,000. The contributions from the sale would be 390, 280. So therefore, instead of having to come in with 190,000, they'll have $67,000 remaining to use the funds. And again, it's the same thing. No payments, property taxes, homeowners insurance. There is a lot of value of having these conversations with people that qualify because they just don't know. They don't know it's possible. And now you guys hopefully do. Okay, so with that concludes the reverse mortgage piece. Let's talk a little bit and switch gears about debt service coverage ratio. This is a DSCR program. So now we're going from reverse mortgages into a product that helps families buy investment property. So this is just an investment property type loan. So what a DSCR loan is, it stands for debt service coverage ratio. This is designed for real estate investors. DSCR loans focus on property cash flow rather than the borrower's personal income. So we don't look at the borrower's income at all. We are solely focused on the property itself, what the payment's going to be, and what the rents that are going to be collected. Now, this is ideal for clients looking to expand their investment portfolios. There's a lot of limitations that conventional financing has that this doesn't have. But here's the formula. It's this simple. The DSCR ratio equals the total rents divided by the PITI, the principal and interest, taxes and insurance. And if there's an HOA, you have to include the HOA there. If there's flood insurance, you have to include that. So whatever that total payment is. Now, most lenders, and don't worry, I'm going to give you an example of this in a second here, but most lenders want that ratio to be 1 or higher. Now, and what that means is basically the rents are going to cover the payment. Now, if it's less, if the rents don't cover the payments, then you're going to be under 1 and you could still get a loan. But some lenders are going to want 30% minimum down. They're going to want to see a credit score. Then all of a sudden there's certain requirements that are going to come in. Whereas if it's 1 or higher, the property can pay for itself. You don't have all those hurdles to go through. So here's an example. We're starting at the top and we're working our way down. So let's say you have a client or your family looking at a house with a purchase price of $750. And let's say you're doing a 1031 exchange or whatnot, and you have about 40% down or 300,000, giving you a loan amount of 450. Now the interest rate today, or when I did this, was 7.5%. So that would give you a total payment, which includes principal and interest, property taxes, and homeowners insurance. Now we're not doing HOA, of $4,128. So your cash to close, right? These are just round numbers, 300,000 plus 20,000, about 320. Just kind of ignore that piece for now. But if you look at the very bottom, the total payment of $4,128 divided by the projected income of $4,500 will give you a DSCR ratio of 1.09. That's it. They're approved. That's all we need to do from a lending perspective is verify that. Now, a couple things that you need to know, right, is number one, the eligible properties are going to be single family residences, multifamily properties, commercial properties, short-term rentals. Some miscellaneous information is going to be, you can do 40 years fixed, interest only, 30 years and interest only. But here's the one that is the most common question, that the rent is determined by the lower of the actual rents received or the appraised rent value. Remember, when you buy an investment property, not only do lenders get the appraisal for the value, but they also get the appraisal for the actual rents projected to receive. So if you already have renters in there and you have that rent appraisal, they're going to go off the lower of the two to determine that ratio. So that is an amazing program, and literally that's all you need to do. Now, conforming loans, let me go back to DSCR. Conforming loans will limit a family to 10 investment or 10 total loans. So if they have so 10. Whereas DSCR loans, there's no limits at all. And by the way, you can close in an LLC and all that stuff. So this is a great program, especially if you're hearing families saying, I think I would really like to invest in real estate, but we don't know if we have the income, but we have the down payment. There's a program for them. Now, the next alternative program, this is for self-employed individuals, people that, it's very common that when you have, let's say, contractors. So we're talking about non-W-2s, non-pay stubs, or tax returns. Now, keep in mind, there's some self-employed individuals that have, like, say, a corporation, and they have W-2s and pay stubs. From a lender's perspective, you're considered self-employed if you own 25% or more of a business. So even if you do receive W-2s and pay stubs, but you own 25% or more, you're still considered self-employed, and we can do a bank statement program for you. So instead of looking at the tax returns where people write off ideally everything they can to pay the least amount of interest, or taxes, because that should be everyone's goal, we're going to look at the bank statements to see what your actual deposits are. So we can look at your personal bank statements and we can look at your business bank statements. Now, I will say this about this, and I want to warn people, not every company is created equal when it comes to bank statement programs. A lot of people will just do the math and just kind of add and divide and say, hey, this is what you're approved for. You really want to get these tax returns underwritten beforehand, because there's things such as large deposits they may not consider. NSFs will really, even if they have the deposits, if there's more than, I don't know, I'm just kind of making this up, but there's multiple NSFs, the lender may not fund the loan. And typically you hear that at the very last minute. That's why you hear, I think that's why non-QM loans have such a bad reputation. It's simply because people don't have the knowledge, or they're not getting it underwritten or taking the time to really look at the bank statements. Also, keep in mind, if we get the bank statements underwritten today and it takes them 6 months to find the house, we're going to ask for that 6 months gap, of bank statements. And if their business went up or down, or they're not making deposits or whatnot, that's going to greatly impact their approval. So an amazing program, as long as you know how to navigate it, which we do over here at Clear to Close Brokers. And if you ever have any questions on that, let me know. Now, it's very flexible. I've already mentioned this already. It's 12 or 24 months bank statements, personal or business. Here's something I didn't mention. You can put as little as 10% down, and credit scores as low as 620, and loans amount up to 3.5 million. Now, I just want to say this. If you have a 620 FICO score and you want a $3.5 million house, it's not going to be a 10% down payment, right? It's just a combination. These are things that are possible with these loans. Now, a debt to income ratio up to 50%. Also, you can combine the bank statement income with other sources. For example, let's say there's a husband and wife. One is self-employed, one is not. Let's say the self-employed individual, we have to use their bank statements, so we can take the bank statements income and the other spouse's W-2 income and combine them and get them approved based off that. So it's an amazing program that should be utilized. Now, here is some things that I'm just going to come at you with. There's about, 6 programs here that I'm going to briefly talk about that I'm just hoping that you get and remember if somebody talks about it. So I'm going to bring this up. So number one, a lot of people are looking for short-term rentals. They want to do like Airbnb and stuff like that. So what we have here is, this is an AirDNA rentalizer. So there's an actual website you can go to that will evaluate or estimate what the projected short-term rental income will be for a property. What we'll do is we'll take that income and divide it by 12, and that's where we get the income for that property. The minimum credit score is 700, 25% down payment for investors with 1 year experience operating short-term rentals. Now, if you don't have any experience, they're going to require 30% down. And it's an amazing program. We used one in Jeremiah. What's that? Is I can't remember where it's called. It's a desert place where everyone goes to near Palm Springs. I'm having a moment right now. But this is a great program, especially for people that want to do Airbnb. Next up, 1099. For all you real estate agents out there and other 1099 people, what this program does is it literally takes your 1099, divides it by 12, and that's your income. Now, what's the difference? Well, when you go on your tax returns, ideally, hopefully you're working with a CPA that's helping you perhaps write off the lease of your car, whatever expenses you have. And so it's really limiting your income. However, with a 1099, they're just looking at what your 1099 income is, and they're going to use that. Now, what they will do, though, just as a little heads up, they will ask for about 2 or 3 months of your bank statements just to confirm that you are actually receiving the money. But that is a great way that if you write off a lot of debts against your income, which I hope you are, this loan will be able to allow you to get approved where conventional financing will not. Of foreign national investors. If you have people that are foreign national investors and want to invest here and they don't know where to turn, they can use that DSCR program. And these are loans up to 1.5 million. They're going to want 30% down, minimum of 6 months reserves. The cool thing is business accounts are eligible for reserves. In a lot of places, especially conforming, they're not. The title can be vested in the borrower's name or an LLC, which a lot of people are preferring the LLC nowadays. This is only for 1 or 2 unit properties, and cash out available up to 65%. So you can do a refinance as well. So this is a huge opportunity for foreign national investors. ITIN borrowers, we got one going right now. It's a bank statement for ITIN borrowers. Purchase rate, term or cash out, primary, second, or investment properties. Minimum 600 FICO score, 15% down payment required, loans up to 1.25 million. Now they do need a 2-year residence and employment history. There's interest-only options available. Alt-A is no credit score is okay. So if they don't have a credit score, that's going to be okay. And then no limit for the amount of finance properties, which is a huge thing. So ITIN is okay. 40-year loans. Now, I just wanted to share that with you. It's possible, but I also want to share with you that 40-year loans don't give you, in my opinion, the big enough drop in payment to actually pay for them. However, if you are looking at like a bank statement program, and you want a few months lower of a payment because you're going to refinance eventually, maybe a 40-year option's worth your while because it'll save you monthly for the time you have the loan. P&L home loans. Now, this is a great program for self-employed individuals. The profit and loss statement needs to be done by a CPA or licensed tax preparer, but we're not going off tax returns. So these are another way to avoid going off tax returns. So we can use a profit and loss. Now you have to put down 20%, minimum FICO score of 620. It's rate term refinance. So you can rate term refinance, cash out, or do a purchase. No supporting bank statements required. That is huge. And the self-employed individual must own 50% or more. Now, here's the program right here that I believe is going to help, especially my real estate friends out there, help more families either increase someone's pre-approval or someone that's being told no. I think I talked about it before, and I want to talk about it again just in case I didn't. What this program does, it is super simple. Let's take scenario one. Let's say there's somebody that's using W-2 income, and let's say they are only approved for $500,000, but they really want a house, let's say at $600,000, and they have some assets. Let's say they have some retirement funds, but they're underage. Underage meaning they can't take their distributions. Let's say they have some savings left over, right? This program allows us to use their W-2 income, and for the assets they have, take the total amount, and I'm going to show you in a second how we calculate that. Take the total amount, divide it by 60, and that's the income we could use. It's huge because other programs, they want you to do a 30-year or it's just interest, but this is literally take it, divide it by 60, and that's the income. That's going to allow people to have an increased pre-approval, or as I mentioned earlier, people that are getting told no, getting told no, this will turn into a yes. We literally just closed somebody. She has a lot of assets. She decided to not go to work, to stay home with her baby and raise her son, which is admirable. And she's living off of her assets, which is her right to do. When she went to go buy a house, because there's no income being generated off those assets, everybody was telling her no. And there's other programs like asset depletion programs and stuff. There just wasn't enough there to qualify her. So we looked at this loan program for her, and she was easily able to qualify, and she moved into her brand new home about 2 months ago. And by the way, the rates on these programs are absolutely amazing. Now, they're not conforming rates, but I would say it's about 1/4 to 0.5% higher, which, hey, that's a great rate when it comes to non-QM. Now, let me share with you how this is calculated. It's really simple. So what we have here is very top, you have cashola. I couldn't come up with a better name, borrower name. The loan amount cashola was looking for was $640. The purchase price was $800, and the closing costs were $20,000. Now, if you take a look here, this is how we determine qualified assets. So let's start from the top: checking, savings, money market accounts. We can use 100% in that calculation. So she had 400, cashola had 458,000. We used 100% in that, and moved it over to the qualified asset account. Now, annuities, mutual funds, publicly traded stocks and bonds, there was about 712. We could use 80% of that and move that over to 569, 728. Now, here's the deal. If Cashola had retirement accounts, 401ks, IRA, SEP, even if they weren't eligible to use them, we could still, because they're not of age, we can still put that asset amount in there and take 70% and use it from a qualified asset amount to determine our income. From there, we have total qualified assets. So in this case, it was $1,027,000. So from that $1,027,000, we have to subtract the down payment and the closing cost of $180,000. And so the total remaining assets after everything was used was $847,797. So here's the test. The test is that the qualified assets minimum is the lesser of 1 million or 1.25% of the loan amount. So in this case, 1.25% of the loan amount is 800,000, which the qualified assets was higher than that at 847. So that's a yes. And then there's a required minimum assets of 450. That's a yes. So that is the only calculation we use to qualify this person's income. That is it. And so as a result of everyone telling Cashola, you can't use any income, we're able to give Cashola $14,000 per month from an income standpoint. That's going to allow Cashola to qualify for a large house, large down payment, more than Cashola wanted to, but Cashola had options. So it's that simple to determine how much income we can increase somebody's by to determine whether or not they want to, get pre-approved for more, or if they're flat out being told no, we can just run this to that scenario. So for all my financial planner friends, this is the program that, a lot of your clients should be using instead of pulling all their money out, which is earning money for them, and putting it into a house, which they can't get out unless they pay fees. So that is the program that you really want to remember. And that's the one I believe that's going to help a lot of families this year buy a house, and a lot of real estate agents increase their business by being able to offer this product to people that have assets, reach out to financial planners and promote this product and really get people excited about buying that, people who couldn't. Okay, we're moving on now. Renovation loans. I told you I was going to come at you guys with a lot of stuff here. Here we go. So renovation loans. Renovation loans, let's take a look here, allows you to finance both the purchase of the property and the cost of the renovations with a single mortgage. There's many different types, right? There's a FHA, there's Fannie Mae has their home style renovation loans, VA has their renovation, Freddie Mac, choice renovation, and private renovation loans are out there. So there's quite a few programs out there. Essentially, how these programs work is, number one, you have to get pre-approved. Number two, you have to identify a property. You have to estimate the cost. And on these estimates, we don't want to go cheap, because this is something that, at the very end, if there's not enough assets there to complete the property, you may have a bigger problem on your hand. Once you estimate the cost, you make an offer, then we submit it for loan approval, closing, complete renovations. Now, here are some tips for doing this. I overly simplified that process, but that is the flow. You identify a property, you figure out how much it's going to take, and what has to happen is that amount. Let me see something here real quick. I don't think I put that in. No, I sure didn't. So that amount, wow, I can't believe I missed this slide here. So that amount has to stay below FHA, not VA, FHA, Freddie Mac, or Fannie Mae conforming loan limits. So let me give you an example. Let's say you guys found a fixer-upper in, let's just say, Petaluma for $900,000. And it's going to need at least $300,000 in there. Now, the max loan amount that we can give is the Sonoma County loan limit, which I wish I would have this written down, I believe is $897. So anything above $897, they have to come out of their own pocket, and it's not going to make sense. So whenever you start working with clients that want renovation loans, you really want to set up that hopes and dreams conversation because there's so much to know about them that, a 15, 20-minute conversation with me, I can really narrow it down and tell them where to look at what price point, etc. You don't want to be showing houses that they won't be able to get the renovation loan funds for it to complete and be stuck with, no loan approval. So there's renovation loans. Bridge loans. Bridge loans is key. We did so many bridge loans last year. This allows people to use the equity from their departing residence. So they have to have a departing residence and to use that leverage there to put in all cash or treat it as an all cash offer on the house that they are buying. Now, keep in mind, we need 10 to 14 days there because we are putting liens on the departing residence and on the residence they're buying. So technically, there is financing and there is trade requirement waiting periods. But our bridge loans, we don't have any underwriting. We are just looking at the values of the property. The simple formula is if you take the values of both properties, take 65% of that, deduct any liens on the property, such as loans, solar, whatever's remaining, that's the max loan we'll give on a bridge loan. Super easy to qualify people on. Now, the key features are they are short term. You want to do 6 to 12 months. Rates right now are about 10 to 11%. And we talked about both secured by both properties, and typically they cost about 2 to 3 points there. So there is a cost to them, but the benefit, so it's not for everybody, but you have to look at the benefit of what the bridge loan is going to accomplish for people. Number one is it allows people to move out, where if you had a client that, you really needed them to move out to get top dollar for their house. Let's say let's pick on my family. We have 5 dogs, 5 kids. If I wanted to show my house and get the top dollar for it probably makes sense for me to move out. So when people came and saw it, there wasn't dog hair everywhere or 5 kids, it's hard to keep a house clean. So I might be able to get more if I was able to leave, get my animals and my dogs out of there. You see what I did there? I called my kids animals. Get them out of there into the new home and then be able to stage it and allow me to get more money. So all of a sudden that 2.5 points doesn't really matter because I'm making it back on the sale, or perhaps on the purchase, it's super competitive. And people out there, in order to get the property, we can go in, removing all loan and appraisal contingencies, treat it as a cash offer, get it done, and move your offer up to the top. So a bridge loan is extremely useful for the right people. Fix and flip. Let's take a look here. I will tell you, if you are talking with somebody that wants to get into fixing and flipping and they don't have any money, I don't know what to tell you. We don't have any sources for them. In this, it's kind of a common sense thing when you loan somebody money that's never renovated a house and wanted to fix or flip it. Experience truly matters. So they will go up to 75% of after repair value. So what that means is they take two values, the purchase price and what it's going to be worth after the repairs, and they use those two numbers to figure out how much they'll lend you. They'll finance up to 100% of the rehab costs. That's assuming there's enough value there. Loans from 300 to 3 million. There's 12, 18, 24-month terms available. There's no income or employment verification, but the experience piece is going to be huge. Investment properties only. So this is not for owner-occupied. Remember, owner-occupied properties are going to be the renovation loans. So these are just for investment properties, and they are going to be, and then you also have the interest-only piece as well. So we went over a ton of stuff in the last 35 minutes. We went over reverse mortgages, if you can remember that way back then. We went over bank statement program, DSCR program, Airbnb type programs, 1099 programs, that asset program where we're able to use people's assets as income to increase their pre-approval or even get them pre-approved. We talked about bridge financing, renovation loans. We talked about it all day, fix and flips. I gave you enough information today to either be extremely confused or very dangerous. I'm hoping very dangerous. Just remember This is recorded. If you want me to send it to you, feel free. If you want to have a conversation, pick my brain about these programs, I got your back. My goal in doing these webinars is to help my real estate partners grow their business, help my families out there, that are being told no, yes. My goal is to help a lot of people get into homes this year. So I really appreciate you guys. I don't know if I'm able to get any questions here. So I'm going to end. And if you guys give me a call, I'll be around. So thank you for your time, and we'll talk soon.